To understand how this all began, we need to go back way back to when money wasn't numbers glowing on a screen. In medieval Europe, wealth meant gold and silver. If you were rich, you had chests of coins or jewels you could trade. But hauling bags of gold around was dangerous, so people started leaving their treasures with goldsmiths' men who had vaults strong enough to keep them safe. In exchange, the goldsmiths gave out paper receipts, simple notes promising that whoever held them could come back and collect their gold. Before long, people realized those notes were just as good as the gold itself. You could trade them, spend them, even save them. They were lighter, easier, and safer to carry. And that's where the trick started. The goldsmiths noticed something strange. Almost nobody showed up to claim their gold at the same time. If they had 100 clients with deposits, maybe one or two would withdraw on any given day. The rest of the gold just sat there. So the goldsmiths got clever. They began writing more receipts than they had gold to back them. If they held 1,000 coins, they might issue 2,000 in paper notes. They'd lend those extra receipts out at interest, making money on gold that didn't even exist. As long as everyone didn't come knocking at once, nobody noticed. It was money made from nothing, and it worked. But this wasn't just a clever side hustle, it changed everything. Once people accepted that paper promises were as good as gold, money creation broke free from physical limits. Banks grew out of this system, turning the trick into an institution. By the 17th century, even governments joined in. The Bank of England was founded in 1694 not to serve the public, but to solve a problem. The crown was drowning in war debt, and the new bank offered a fix. It lent the government far more money than it actually had in exchange for interest. That debt wasn't paid back with gold from new conquests, but with taxes from ordinary people. Sound familiar? It should. Governments still use the same playbook today, borrowing money that doesn't really exist and handing the bill to future generations. The United States followed the same path. Early American banks printed their own notes, promising they could be redeemed for gold. But bankers quickly figured out the same thing the goldsmiths had centuries earlier. They could print more notes than the gold they actually held. Every so often, people caught on. Crowds of nervous depositors would rush to pull out their money, only to find the vaults half empty. Entire banks collapsed overnight, and instead of tearing down the system, the government stepped in to protect it. They created central banks to keep the illusion alive. The message was simple. Even if the money isn't really there, we'll make sure people keep believing it is. Now, let's translate that into today's world, because fractional banking sounds abstract until you see it in motion. Say you walk into a bank and deposit $100. You assume that money sits safely in your account, ready whenever you need it. But that's not how it works. The bank only keeps a small slice in reserve. For years, that fraction was around 10%. So the bank would hold $10 and lend out 90. Maybe someone borrows that money to buy groceries, and the shopkeeper deposits that 90 into another bank. That bank keeps 9 and loans out 81. The cycle keeps repeating: deposit, lend, repeat until your original $100 has multiplied into nearly 1,000 circulating in the economy. But here's the kicker. Only the first 10 ever existed as cash. The rest is debt. Every new dollar in the system is born as someone's promise to pay it back with interest. And if that surprises you, brace yourself, because that version of the story is already outdated. In the United States today, reserve requirements aren't 10%, they're zero. Since March 2020, banks have been allowed to hold nothing in reserve, not a single dollar against your deposit. So if banks don't need reserves, what keeps them from lending infinite money? The leash isn't reserve ratios anymore, it's a set of international rules called Basel. These rules came after decades of financial crises, especially 2008, and were written not by Congress or Parliament, but by central bankers and regulators who meet in Basel, Switzerland, at the Bank for International Settlements, the so-called Central Bank of Central Banks. Here's the short version. Banks now have to prove they have enough of their own capital to absorb losses. If a bank wants to make a risky $100 loan, it might need to hold $8 of its own money as a safety buffer. The riskier the loans, the more capital they must hold. On top of that, banks must show they have enough liquid assets, cash, government bonds, anything they can sell fast to survive a short-term panic. These rules are meant to stop banks from flying too close to the sun. But notice what changed. Banks don't lend from deposits anymore. They lend first, and the deposits appear afterward. When you take out a mortgage, the bank doesn't dig cash out of a vault. It simply types new money into existence in your account. That money exists only because you agreed to owe it. Afterward, the bank checks if it has enough capital to make the numbers add up. That's why most of the money in circulation today isn't cash or central bank reserves, it's bank money created the instant loans are made. Think about that. The balance you see in your checking account isn't the same kind of money the Federal Reserve prints. It's private bank money, money born as debt. As long as banks keep finding borrowers, the system keeps expanding. And every financial crisis is really just a crisis of confidence, because once people stop believing in the promises or stop paying them, the whole thing starts to come apart. This setup creates three outcomes that can't be avoided. The first is inflation. Because banks keep multiplying the same dollars into more and more credit, the value of each dollar keeps slipping. Prices rise not just because of supply and demand, but because the currency itself gets watered down. The second is endless debt. Since every dollar comes into existence as a loan, there's always more debt in the system than there is money to pay it off. Interest makes sure of that. Someone somewhere always has to borrow more, refinance, or default. The books never really balance. The third is power. Banks collect interest on money they never truly had. Governments use this same system to fund wars, welfare, and bailouts without raising taxes outright. And the wealthy, the ones holding real assets like property, stocks, and commodities, benefit as inflation pushes those prices higher. Meanwhile, ordinary workers watch their paychecks buy less every year. When the machine hiccups, the illusion cracks. Think back to the Great Depression. In 1929, banks had lent far beyond their reserves, fueling a massive stock market bubble. When panic hit, people rushed to pull their money out, but the money wasn't there. Thousands of banks went under. The same thing happened in 2008. Banks had built mountains of credit through mortgage-backed securities, an elaborate web of promises based on shaky loans. When those loans started to fail, the whole system began to collapse. And once again, governments and central banks stepped in, flooding the system with trillions of new dollars to keep it from imploding. They didn't fix the trick, they rescued it. Because without it, the modern economy can't function. This is where the global picture comes into focus. In the US, reserve requirements are gone. In places like the UK, Canada, and Australia, they're little more than symbolic. All of them rely on the same Basel framework, now the international rulebook that quietly sets the limits on how banks operate. Meanwhile, in emerging economies like China, India, and Brazil, reserve requirements still exist, often in the double digits. Regulators there use them to control how much banks can lend. But even those systems sit under the Basel umbrella. The real leash on money creation isn't a vault full of deposits. It's a spreadsheet of regulations written in Basel, Switzerland. And here's the uncomfortable truth. This system can't afford for everyone to be debt-free. If every household paid off every loan tomorrow, the money supply would vanish. Banks would have nothing left to lend, and economies would freeze in place. The illusion depends on you, the borrower, the spender, the believer. The system needs you to keep the cycle alive, to keep trusting that the digits in your account mean something real. You're both the fuel and the collateral. That's why history still matters here. The same trick that goldsmiths used centuries ago has been scaled into the foundation of modern finance, and the same risks still lurk beneath it. Bank runs in the 1800s, the Great Depression in the 1900s, the housing crash in 28 different centuries, same story. Each time, when confidence cracks, the whole thing starts to shake. And every time, instead of stopping the trick, we double down, patch the holes, and keep moving like nothing happened. So what should you take from all this? First, that money isn't the same thing as wealth. Real wealth isn't digits glowing on a screen. It's land, resources, skills, knowledge, and independence. It's the kind of value that holds up even when paper promises don't. Second, debt isn't neutral. It's the bloodstream of a system built to favor lenders, governments, and asset owners at your expense. Every loan keeps the machine alive, and every repayment keeps you inside it. Third, inflation isn't an accident. It's baked into the design. Every year, you're asked to run faster just to stay in the same place because the value of your money keeps slipping beneath your feet. Does that mean we're doomed? Not necessarily, but it does mean you need to rethink your relationship with money. Saving cash in a bank won't shield you, and blind trust in the system won't set you free. Real wealth, the kind that survives outside the loop of debt and inflation, is what builds real freedom. The lesson isn't paranoia, it's awareness. If money is born as someone else's debt, your freedom depends on stepping outside that cycle. History doesn't repeat, but it definitely rhymes. The goldsmiths of medieval Europe, the panics of the 1800s, the housing crash of 2008, they're all verses of the same story. a system that multiplies promises beyond reality, and a public that believes until belief collapses. And this story isn't over. Every major financial crisis we've ever seen is proof that the whole thing runs on confidence, not gold or productivity. And confidence is the easiest thing in the world to lose. So the next time you check your bank balance, remember, most of it exists only on paper, born from a system of debt that was never built with your freedom in mind. See the trick for what it is, and you can start protecting yourself from it. Ignore it, and you stay a player in a game where the house always wins. If this opened your eyes, stick around. History has the answers, and I'll help you find them.